Assalamu alaikum and welcome. Have you ever stared at the stock chart and just felt completely lost? You know, with all those peaks and valleys and these wild jagged lines, it can feel like you're trying to read a totally foreign language. Well, today we're going to decode it. We're going to learn how to read the market's mind. So, when you look at a chart like this, what do you actually see? Is it just a bunch of random noise, a meaningless squiggle that just bounces up and down for no real reason? Or, and this is the interesting part, is it something more? Could this chart actually be a map? One that shows us the psychology, the collective fear and excitement of millions and millions of investors all at once? Well, that's what this explainer is all about. We're going to find out how to read these maps. Okay, let's dive right in. First things first, let's start with the absolute basics. Before we can even begin to decode those squiggles on a chart, we really need to get a handle on what they're even representing. So, what is a stock? The easiest way to think about it is like you're buying a slice of pizza. Seriously. When you buy a stock, you're buying a tiny piece of an actual company. You become a part owner. So whether it's one share of Apple or any other company, you've just bought what's called equity, your very own slice of that business pie. And just to give you a sense of the sheer scale we're talking about, a company like Apple has a market capitalization. That's just the total value of all its shares put together of around $2.85 trillion. So yeah, your single share is a very small piece of that. But hey, it's a piece nonetheless. So where does all this action happen? Where are all these little pieces of companies being bought and sold? Well, that's the stock market. And it's not actually one single physical place, but really a collection of different exchanges. You've probably heard of the big ones like the New York Stock Exchange or the Nasdaq. And here in Malaysia, we have Kuala Lumpur Stock Exchange, or better known as Bursa Malaysia. That's where all this trading happens every single day. All right, so now we know what we're treating. But how do investors decide what to buy? And maybe more importantly, when? Well, it turns out there are two main schools of thought on this. And a good way to think about it is like a detective versus a psychologist. On one hand, you've got fundamental analysis. This is the classic detective work. These analysts are the ones digging deep into a company's financial health. We're talking earnings reports, debt levels, the quality of its management, all to figure out what that company's true value is. But on the other hand, you've got technical analysis. This is the chart psychologists. They're not nearly as concerned with the company's books. Instead, they study the price chart itself because they believe that's where you can see the collective psychology of the market playing out. And you can really see the difference right here. The fundamental analyst, our detective, is poring over business reviews and financial reports. Meanwhile, the technical analyst, our psychologist, is looking for patterns and trends right on the chart. They're using two completely different toolkits to try and achieve the exact same goal, figuring out what's going to happen next. And that brings us right to our main topic. So, if we're going to get formal about it, here's the definition. Technical analysis is the study of market action primarily through the use of charts for the purpose of forecasting future price trends. Now, the key words to focus on here are market action and charts. It's all about what the price is doing right now and what it's done in the past. But, technical analysis is more than just looking at charts. It's actually built on a whole philosophy about how markets work and how people behave. So, let's explore some of the core beliefs that this entire approach is built on. This right here is the central pillar, the big idea. It's the belief that by the time you or I hear a piece of news, whether it's an amazing earnings report, a new product launch, or some big global event, the market already knows. All of that information is already baked into or discounted into the stock's current price. And this isn't some new idea that someone just came up with. It's actually the core of something called Dow theory, which is a framework developed by Charles Dow more than 100 years ago. It's pretty much the bedrock that this entire field of study is built on. So Dow theory itself is built on 6 key beliefs. First, the market has 3 types of trends going on at once: primary, secondary, and minor. The best way to think about it is like the tide, the waves, and the ripples on the water. Second, major trends have 3 phases. There's accumulation, then public participation, and finally distribution. It's kind of like the life cycle of a trend. Third, and we just touched on this, is that stock prices react to all news almost instantly. Fourth, the major stock indexes like the Dow Jones and the S&P 500, they have to confirm each other's trends. They need to be moving in the same direction for a trend to be considered valid. Fifth, trading volume should go up in the direction of the trend. And finally, number 6, a trend is basically assumed to be in effect until you get a clear, definite signal that it has reversed. These are the rules of the road for any technical analyst. Okay, I know that was a lot of theory, but how does this all actually play out in the real world? What's the bottom line? Well, the key thing to understand is that these two approaches, fundamental and technical, they're really answering two very different questions for an investor, and this right here illustrates the difference perfectly. Fundamental analysis helps you answer the question, what should I buy? It's all about identifying good, strong, valuable companies. Technical analysis, on the other hand, helps you answer the question, when should I buy or when should I sell? It's all about timing your moves based on market sentiment. And actually, a lot of investors use a combination of both. So, what's the big idea we should walk away with? At its very core, technical analysis is really a bet on human nature. It's the belief that our collective emotions, our greed and our fear, are actually pretty predictable, and that those predictable emotions paint a picture on a chart that we can learn to read, which kind of leaves us with a fascinating question to chew on, doesn't it? Is the market really just a cold, calculating machine that's driven by spreadsheets and financial data? Or is it something a lot more organic? Maybe it's just the collective rhythm of human hope and fear playing out for all of us to see on a simple chart. Definitely something to think about.